Jennifer Schulp, thank you for joining us on Money and Politics Now. And we are going to be talking, for the sake of the viewers, about some of the changes that are going on in the investment world. And you follow the investment world and some of the regulations that apply. Why don't we just start, if you would, and tell us just a little bit what you do at the Cato Institute in your financial studies?
Sure. My title is Director of Financial Regulation Studies at the Cato Institute in what's called the Center for Monetary and Financial Alternatives. Kind of sounds like a broad title, but my focus of research and my focus generally is on securities and capital markets. So I spend a lot of time paying attention to what the Securities and Exchange Commission is doing, as well as keeping an eye on our markets and how businesses can raise capital in those markets.
You know, it is such a changing landscape. When I started investing, you would call up your stockbroker, as was the case in my father's time. And I think Charles Schwab was one of the leaders in online investing, probably around 1975 or so, maybe that far back. And now we have any number of online investors. There's been some consolidation in the industry. In fact, I believe Schwab has purchased Ameritrade. But the fact of the matter is that we have a growing number of applications in which people can invest in. And it's not only Schwab and Ameritrade and E-Trade, but now of late we have Robinhood. And that's another application where people can invest, and in fact, through a phone application. So, is that something that you have studied? And if you have, to what kind of results or findings have you found?
It is something that I pay a lot of attention to, and it's been an area that I've been focusing on, particularly over the past year to 18 months as I've come on at the Cato Institute. It's a pretty exciting time to be talking about individuals or retail investors trading. You're absolutely right that when years ago, we're talking about in the mid 1970s, the big innovation was discount brokerages, where individuals could call up their broker. Schwab was the pioneer in this field, and make trades for what was then viewed as a reasonable commission. Those reasonable commissions were $50 a trade, $75 a trade. So not what we think of today as discount, but that was a big discount from what it had been prior to the advent of discount brokerages. As we kind of continue along that saga and that story, we've had a lot of changes in retail brokerage over the years, including the creation of E-Trade in the late 1990s, where you could log onto your computer and engage in self-directed brokerage, where you no longer needed to call up your broker. You could just type in what you wanted to be done. Again, you were still paying for that. And the interfaces tended to be a little clunky, as everything on the internet was in the 90s and early 2000s. The next big change in this area has been, I think as you said, kind of what we consider to be the Robinhood type changes. Now Robinhood as a brokerage doesn't stand alone in this zone, although they tend to have pioneered some of the things we think about today when we think about what we call app-based trading. And that's trading from your phone, trading from the palm of your hand, which is not only easier, quicker, tends to be more fun. The interfaces are more of what people are used to using for other apps these days. And what's also come along with app-based trading and with Robinhood is what's now known as zero commission trading. So we were talking before about, trades costing $75 to make one trade. Now you pay no upfront service charge on many of these apps and with many brokerages in order to make a trade. It's a little false to call them free trading, because it's not really free, and I'm sure we're going to talk more about that as we move along. But now people have access to trading in the palm of their hands for a very small amount of money to make a trade, which really brings investing to a whole new group of people that didn't have easy access before. And we've definitely seen that happening over the past several years.
Jennifer, it's interesting. When I grew up, my father would talk about investing at the dinner table, and that was back in the 1960s. And what is fascinating now to think about, in a world in which we have zero commissions on online brokers, that, as I recall, my father used to pay back in the 60s something like maybe $50 a trade. And when you adjust for inflation, that would almost be, hundreds of dollars in today's dollars. So it's one of the things that's really changed is before you would buy 100 shares at a time. So not only did you have a high commission, but you had to buy what they used to call a full lot. And if you bought less than a lot, if you bought like 10 shares, they would charge you a higher commission for that. So it has really been liberating for, I tell, a lot of people getting in. Nowadays, you can go in and even if you're going to buy one share, I tell you, buy one share, buy two shares, buy what you can, but don't not buy because you think, oh, well, I'm not buying enough. I tell people, it's how much your money is going up on a percentage basis. And there are different stocks that I follow that have gone up, over 1,000% in the last 5 years. So even if you had invested a small amount, that money would have grown proportionally. Now, one of the, for the sake of the viewers, I use Schwab. I've used them for about 30 years, but one of the new apps is Robinhood. And when you're talking in your studies, one of the articles you had mentioned that investing apps like Robinhood aren't gambling tools, as some critics might say, that push investors to make risky decisions. You wrote that they're actually a great way to teach young people how to invest. Can you expand on that? Why is it that you think that things like Robinhood are a great way to teach people how to invest and through investing perhaps expand their financial literacy?
Absolutely. I think what you just talked about really hints at what's been great about these new app-based trading and the new innovations in trading generally over the last 5+ years, is that they've lowered the barriers to entry for people to start investing. You don't have to buy a full lot. In fact, you don't even have to buy a full share on a lot of these apps. Over the course of 2020, a lot of brokerages rolled out what's now known as fractional share trading. So if you're really interested in owning a piece of Amazon, but can't afford a full share of Amazon, you now have an opportunity to buy a little piece of Amazon. And this has been a great way for people to start learning how to invest. It doesn't matter if you only have $20 to put into your account. It doesn't matter if it's only $100. It doesn't matter if you want to put in a little bit of each paycheck in order to start building your investing base. You can do that in a much more economical way than ever before. And I would say Robinhood, among others, I would say Schwab has some of these innovations as well. Fidelity, a lot of the apps, Webull, Public, there's a proliferation of new entrants into this space that make it easy for people to just start investing. And we have a tough time with financial literacy in this country. We certainly don't have everyone sitting at the dinner table talking with their dad about investing. Wasn't something that I talked about much growing up, but we probably talked about it more than a lot of families do. And people are not necessarily learning about investing at their dinner tables. And when they learn about investing in a high school class or in a flyer that they're given at a job fair or something else that's trying to teach them, it's not the same type of experience as sitting down and learning by experience. That's not to say that classes and books can't add to the financial literacy landscape, But really, learning by doing is one of the best ways to learn. And it's a great way to reinforce what you've picked up in a handout or in a conversation.
We look at the things we talk about in our society, how to make people better. We talk about uh, cutting taxes or raising taxes, which is fiscal policy. We talk about the interest rates being low. It's I was critical the other night when I was guest hosting on a radio show of some of the journalism, and I've been in journalism for about 30 years or more. But I had a background before journalism of running a business and learning how a lot of finance works and the tools of finance. I'm critical of journalists and journalism schools, I should say, for allowing people to graduate, even get postgraduate studies in journalism, and they never teach them anything about how the stock market works. Why do we have a stock market? Or any of the financial tools, and I think that shows in a lot of our reporting. So I would say to folks, it's not just about making money. It's not a get-rich-quick scheme to invest in the stock market. And you really have to go over and plow the field with very basic concepts here, because so many people have never had any introduction to why do we have this. And I often ask people, why do you think we have the stock market? Why do we have a bond market? And the short answer is it's a way of aggregating investments. As I say, if you ever raked leaves as a kid and then jumped into the pile of leaves, that's kind of how the stock market works. You couldn't jump into the pile when the leaves were scattered across the lawn. But by aggregating them, you could do something when they were collected that you couldn't do when they were scattered. So when I put my dollars in, or you put your dollars in, we get enough money to say, hey, Steve Jobs, why don't you get out of your father's garage and let's start Apple as an actual business? And so you might say that the stock market is a way, I would argue, how we finance the future. And to the extent that we, as individual investors, buy a piece of stocks that go up, we all can participate in the growth of the global economy, or at least the United States economy, depending upon what you're buying it. So again, I don't mean to be pontificating here, but just to kind of lay out some of these items. Now, one of the things, as you were writing in your studies and in preparing for this, and you also participated not too long ago in a congressional hearing on Robinhood, and what was going on with GameStop and some of that. There was a term that came up that was gamification, and what is that term? That's something that's new to me, and is that something that we should be aware of? Is that something that the Securities and Exchange Commission is concerned about? Can you give us a little idea behind that terminology, gamification?
Sure. Gamification is an interesting term, and that it's hard to find a agreed upon definition. And it's a term that's existed for quite a long time in relation to things that are not the financial markets. So there's been what is considered gamification of a lot of areas in American life. And when I say gamification, I mean kind of adding game-like elements to non-game things. So one of the examples that I like to throw out of kind of a form of gamification that we don't think about often is airline frequent flyer mile programs are gamification. They encourage you to collect points. It encourages you to be loyal to your airline. That's an early form of gamification. But gamification has been used now for decades in education and in other areas to help people engage better with material. So any sort of corporate training that you've taken online that has a pick an A, B, C, or D, that's gamification. And gamification itself has been shown in a lot of these areas to increase engagement and help with retention of information. When we're talking about gamification in the financial markets, that term is being applied kind of somewhat derogatorily to app design that makes trading seem to be more fun. So the stereotypical explanation of gamification that's given is on the Robinhood app, when you would say complete a trade, for a time, a little graphic of confetti would pop up when you completed a trade. And that was considered by many to be gamifying trading, because it was giving you a reward for having made that decision. Now, gamification, depending on who you're talking to, applies to a ton of different things in the app-based trading space. The color of the background that's being used, whether or not there's a leaderboard that tells you what stocks are doing well today, whether or not there's a recommendation feature that says, hey, you like these stocks, you might like these. And it's something that we've been talking about a lot over the course of the past year, with relation to Robinhood and the SEC, and Robinhood and others. I don't want to just say Robinhood, because Robinhood's far from the only company that's involved here. The SEC has expressed interest in gamification and in figuring out whether gamification needs to be regulated more. The SEC chair, Gary Gensler, has talked at length about this. The SEC put out a request for comment from the community, from the public, a couple of months ago on what they're calling digital engagement practices, which is a fancy way of saying gamification. And they're concerned that this gamification of trading is causing people to not take trading seriously and treat it like a game, or that it's causing people to make decisions about their investments that are not in their own best interest. So that the gamification is, for example, causing them to trade more often than they should be trading. I think this is a very complicated area, and an area that the SEC will probably do best to tread very lightly in, because a lot of what they're talking about are the types of app design choices that make people want to use an app. It's marketing by the trading platform, or it's my ability to get a push notification from the app telling me what my balance is. And these are things that people like in modern trading apps. It's design features that have drawn people in. And with the big increase in the number of people who are trading these days, we should be very happy about that. In fact, over the course of the past year or so, the percentages of people that are trading have really increased in kind of who were the people that were left behind before.
Yeah.
More women, more minorities, more lower income people, more younger people, all of whom we would like to have more heavily involved in the stock market. The stock market can be a good investment.
Right. I was going to insert that as I mentioned, that I grew up in a household where my father would talk about investing at the dinner table. But I know there's other areas where, impoverished areas of the country, where there's probably individuals born into those communities and they don't know anyone in their universe who ever bought a stock. So when we talk about gamification and the idea that perhaps these apps are going to have people invest too much or invest too frequently, while there might be something to that, we should also recognize that there's a very serious and ongoing problem of impoverished people never putting any dollars to work where those dollars can grow through the advancement of the market. You have one of the clips we took from an article that you were one of the authors of, where you say, with all the talk about protecting investors, it's important not to lose sight of the fact that people who are kept away from the markets by the high cost or burdensome regulations lose the opportunity to become investors. And innovations in trading platforms that encourage new investors to enter the market can play a powerful role in educating them just by providing them with the experience. And I would agree with that wholeheartedly. I often say you can read a book about driving, but it's not the same as having your hands on the steering wheel and driving a car. Experience is always the best teacher. And even if one starts by trading with something like a Robinhood, maybe those people will then progress and go to Ameritrade, Schwab, E-Trade, or some other platform. But you have to start somewhere. And I find that often the problem is that people never get in the game. I am a big proponent of people to become financially better off by saving some money and putting it to work. And I think it's just within the last year, I believe, that Schwab eliminated their cost. They went from about $10 down to $5 and then eliminated it. So again, if people would buy even one share at a time of something, or as you said, these fractional shares, also a brand new opportunity for people. And you make a good point with Amazon, which is somewhere in the neighborhood of, I don't know, $3,300 a share. Yeah, if you can buy a fractional share of that, then you can participate in those markets. How much do you study what the Securities and Exchange Commission does? To what extent is that a part of your job? And are there any areas where the SEC under the Biden administration are looking into new regulations that perhaps the rest of us haven't heard about?
Yeah, so I'm laser focused on what the SEC is doing. That is a very large portion of my job. And I think there's two areas that people who are investing as retail investors should keep an eye on. And one of those is gamification, which I just talked about. The SEC is interested in understanding more about how these platforms operate and about how they're using artificial intelligence. And I have some concern that the SEC is more, I would say, at least the chair of the SEC is interested in more heavily regulating this space. The end result of that could be any number of things. They haven't made a regulation proposal at this point, but I'm keeping an eye to make sure that what the SEC does in this space doesn't raise barriers to new investors, making the markets less attractive to them, making it harder to trade on their phones, making fewer trading platforms interested in entering. One of the great things that I just wanted to mention that I thought of when you were talking about moving from Robinhood to Schwab to Ameritrade around the block is that regardless of which platform you're choosing to invest with at this point, there is a lot of competition among trading platforms who are offering different features. So if you're not happy using one that isn't offering the type of features that you're interested in, take a look around, because these platforms are competing with each other on user experience and are looking for different segments of the population. Some specialize in helping new investors, some specialize in allowing you to make more complicated trades, some specialize in providing research. So there's a lot of competition. But to get back to what the SEC is doing, the other place I wanted to talk about was the other area that the SEC is interested in regulating is in what's known as payment for order flow, which is, it sounds like a complicated term, but it's basically what supports platforms like Robinhood offering you zero commission trading. And payment for order flow is an arrangement that Robinhood and others have with the broker that executes the trades for them. So when you make a trade on somewhere like Robinhood, you make the trade and then Robinhood sends that trade away in order to be executed. And they send it to what's known as an electronic market maker or a wholesaler. I think in the news, if you've heard of it, Citadel is one of those. Virtu is one of those. And Robinhood has an arrangement with its wholesalers to have the wholesaler pay them some portion of money for the order flow that the wholesaler gets to use. That's the money that is supporting Robinhood's business and allowing it generally to not charge you an upfront commission for making the trade. This is a long-standing practice. It's come under a lot of scrutiny lately. And the SEC chair, Gary Gensler, has been making indications, making noise about considering banning this practice. His underlying desire to ban it or to look at it more closely is the concern that when Robinhood is selling the orders to a wholesaler, Robinhood is more concerned with how much money it might be getting from the wholesaler than if your trade is getting a good price. The SEC already looks at these things. There's what's known as the duty of best execution, which is you getting a good price, you getting your trade filled in a timely manner. And the SEC separately enforces what's known as the duty of best execution and has looked over the years multiple times at this payment for order flow to see if it was compatible with a duty of best execution. The SEC never found it to be a problem before. They've put some safeguards into place that seem to work relatively well. And there, to me at least, there's no indication that we should go about banning a practice that has worked pretty well, is subject to other oversight, and is supporting an ability to allow people to trade more cheaply than they have been able to trade in the past.
A number of the people who listen to my channel here, Money on Politics now, will trade on the over-the-counter market as well as the NASDAQ. My experience has been predominantly on the NASDAQ and the Dow, and not on the OTC. Are there concerns with the SEC? Are they looking at the OTC, which is sometimes kind of a Wild West show, that you have some of these fly-by-night operators do operate on there with these penny stocks, and then on the other hand, it can be a very good way for some companies to become publicly traded, and then they move up to be uplisted to the NASDAQ. But I didn't know to what extent is the Securities and Exchange, or I'm not trying to make an issue where it doesn't exist, but is anyone looking at the concerns about the OTC and how to protect people from being lulled into buying into these cheap stocks? I mean, this was the Wolf on Wall Street, and how he operated by getting people to buy into what were basically rather bogus companies in many cases.
Yeah, the OTC markets obviously function a bit differently than the NASDAQ or the NYSE, and there tend to be fewer protections from the types of, say, bad actors that typically don't find themselves on a listed market. The SEC has had a long-standing concern there, and there have been rules over the years about penny stock trading and the types of protections that brokers need to put into place when someone is trading in penny stocks. I'll say a recent development in that space is that the SEC just put into place rules that went effective at the end of September that limit the ability of retail investors to trade in some OTC stocks if those stocks have not been providing up-to-date disclosures. This is a new development. It'll be interesting to see how that plays out, and the SEC's, I think, going to continue to look at that space. I think there's pros and cons to the approach that the SEC has taken there. They essentially have locked retail investors out of the opportunity to invest in some of these companies. Some of those companies are likely not good companies to invest in. There's likely fraud going on there, but
not in all of them, but certainly in some. But there are also some but there are also some that are perfectly viable businesses that deserve investors and that retail investors should have the opportunity to invest in.
So there's a difficult balance to strike there. I'm not sure that what the SEC has done is good in the long term, but there is ongoing concern from the SEC with the OTC markets. I'd say it's just kind of the next phase in the long story of trying to protect people from fraudsters in the OTC space.
I won't keep you much longer, but one of the things, and I don't have it in front of me. One of the items I read in looking at some of the articles that you were involved in producing was talking about how many minority investors, or black investors, are coming into the market where predominantly they had not been there before, but they are now, the younger generation of African Americans are getting into the marketplace in increasing numbers, which was interesting to read and I think very promising. Was that something, I don't know if you can expand any more on what you find as far as trends among, let's say, the millennials and younger, the younger people who are getting into the market. Are they more daring than their parents? Is there a difference between men and women, or I don't know to what extent you've analyzed the marketplace?
It's been difficult to get kind of granular level data on that, but there's definitely been an increase, particularly over the past 18 months, in minorities and younger people entering the marketplace. This is great. Up until recently, the stock market, there's a wide swath of people in this country that are invested in the stock market, but most of them tend to be invested in their retirement plans only. And even among those people, it tends to be older, whiter, and wealthier people. And the stock market is a great place to be able to build wealth, because even if what we have inequality-wise in this country, if everyone is paid the same amount across the board, if you don't invest the money that you have similarly, say, for example, if someone's just leaving their money in a savings account today, the savings account is making a piddly amount of interest, versus putting it in an index fund that tracks the S&P 500. Long term, the person that just put their money in the savings account is going to be left behind. And it's a great way for us to start thinking about helping to build wealth, helping to build generational wealth in populations that have been left behind. So I'm really excited to see this kind of broadening of participation in the stock market. And I'm very leery of any changes that the SEC could be looking at that might cause people to turn around and exit rather than staying in for the long haul.
Yeah, as you say, when we talk about equality, you're not going to have equality in education. You're not going to have equality in income. It all depends what part of the country you live in. You're living in the Washington, D.C. area. You're paying much more for housing. I used to live there than I would pay in the middle of Illinois. So there's all kinds of variables out there. But one constant, I would say, is you're right. If people were to invest in the markets and get some background, and these days, I'm a big fan, as an example, of Yahoo Finance, because you can go on there and you can, compare two things, as I have right here, comparing DIG, which is a leveraged investment in the oil field, which is the light blue, as compared to the S&P 500, which is the purple. And so you can put 2 or 3 or 5 different items up and compare which of those are the better thing over a 1-year period, or 5-year period, or whatever. We have the essences. We have so many tools at our disposal now those are free. Investing now is, while you say technically not free, at least we're not paying upfront that $5 to $10 commission level. And even that was, as we said earlier, a great improvement over the past. I would hope that this conversation, for those who are watching and haven't invested yet, would encourage people to go out and start. And again, buy some small amount, stick your toe in the water, so to speak, and you will learn by doing. And people like Jennifer that we thank you for joining us and educating us on what's going on. I hope that we can follow up with you throughout the year from time to time because, and before I close out, I should say, Jennifer, as you study these markets, and now we have even more changes, and maybe this is a future interview we can do, but as we move to things like Bitcoin and these digital currencies, and the trading of that on platforms like Coinbase or Binance, it's really just changing so much, the whole world of investment opportunities. But I sometimes remind people that when you look in your wallet or your back pocket and you pull out credit cards or debit cards, that all of those are financial tools that were invested, and they weren't around in the 1950s. Now they are. And we keep making new financial investments to address different, problems in the marketplace or to take friction out of transactions. And now we have some of these currency coins, and even people like Jamie Dimon with the, Chase Bank still questions whether Bitcoin is a fraud or not. So there's plenty of things to be talking about, and we do want some regulation, right? We want regulation to save investors from the fly-by-night guys or the Bernie Madoffs of the world. And so there is a right balance that needs to be found, but hopefully we don't have the kind of regulation that chokes off opportunities and would keep, as you've written about, from some people from getting into the market. Mm-hmm. Well, we thank you so much, and if you have any last words, we'll let you have them. Otherwise, we'll let you go and look forward to talking to you again in the future.
I just have, 1-2 sentences. I mean, I think you're right. It's a very exciting time to be talking about our financial markets and to be talking about investing. There's a lot of innovation, and I think it's very important. It's my job to keep an eye on what the regulators are doing. But it's important for people to understand as well how the regulations themselves and the way the SEC talks about things can stop innovation or new things from happening. So it's important to keep an eye on what the regulation looks like as well, not just what your portfolio is doing. So it's an exciting time. I'm happy to be keeping an eye on it.
Well, and we're happy to have you join us. Thanks again.
Okay, thank you.